Today, we're investigating how to navigate the nuance and complexity of fintech with Matt Ford, partner at Mouro Capital and fintech entrepreneur. Matt, welcome to the Fintech Files.
Thanks for having me.
Great to have you here. So we hear a lot of catchy narratives that perhaps dominate the space and analogies. One of them, which I really like, is everything is going to be fintech from Angela Strange. Or there's a played for X, which has started recently, and X as a service. Why do we need them?
Yeah, it's a good question. Analogies generally are a really powerful tool. So as VCs and as entrepreneurs, often the solution that you're either being pitched or pitching is incredibly complex. And often VCs have so many different businesses. Having an analogy to anchor it to can be really helpful just to get you through that initial learning curve. I quite often use the example of Rover, which is often called the Uber for dog walking. You don't have to know what Rover is, but everybody knows what Uber is. It's on demand, it's an app, you get taxis to come to you. So drawing that analogy between the two is really helpful, because you go, okay, Rover, dog walking, it sounds a little bit like Uber, so it's probably dog walkers that come to me and can easily access it by an app. So I think that's a really nice example, because you don't need to get down into all the complexities about what the business is, what the business model is, how do you access it. You just have a really simple understanding. And I suppose to draw that back into fintech a bit more, the Angela Strange quote of everything is becoming fintech, and the AWS for fintech is what she often talks about as well from an embedded finance perspective. Again, it's a really helpful analogy, because most entrepreneurs and VCs know what AWS is. They know that why would you want to have your own servers when you can use the services of AWS, pay as you go, super simple. You're not having to maintain any of that infrastructure yourself. So if you apply that similar approach, as opposed to fintech, you very quickly start to understand what those types of models look like. Analogies can be really helpful, and it's about that initial comprehension gap. But I suppose there's always a challenge to that. It sounds a bit cheesy that every entrepreneur needs to have a slide which says we're the X for Y, or to try and draw that down. You're really addressing the first 20 seconds of comprehension to really get you almost to sit up and to recognize and to acknowledge that there's an opportunity here. It's then about digging down into the detail and really teasing out those nuances and really digging under the hood to get to the complexity to properly understand what a business is about.
Yeah, it's about different levels. And I've been particularly inspired by your articles in terms of understanding the fintech space. So why do you feel like sometimes we require more nuance?
Yeah, it's become a bit of a trend of what I've been writing about recently. Fintech generally is complex. It sounds a very narrow space, but actually it's incredibly broad. There's a huge amount of differences between what a really successful business can do and can look like and those that aren't. And often they can look quite similar, but often the thing that makes a business successful is not the obvious thing that you first understand. It's once you lift the hood and when you get into the details. So yeah, it's become a bit of a trend in some of the blogs that I've been writing recently of trying to segment the markets in a different way, really tease out the differences in business models. And I suppose to reference one I've recently written, I wrote one called 50 Shades of Plaid, which is really just kind of looking at this trend of talking about everything being the plaid for X. So that could be the plaid for payroll, it could be the plaid for HR data, for accounting data. There's a lot of companies now that are starting to draw that parallel and draw that similarity. And to go back to what we were saying before, that's incredibly helpful to get an initial understanding of the type of business that it is, i.e., it's about accessing data, it's an infrastructure business, and it's about connecting disparate data sources or siloed data and enabling others to use it. But actually, that's where the parallel ends, really, from a usefulness perspective. And I think really diving down into that detail, let's just actually take payroll data as an example and compare it to Plaid. So the thing that made Plaid such an amazing business and such a valuable business was that they were operating in banking data for a start. The banks did not want anyone else to have that data. The incentives for the bank to let that data out were incredibly low. Banks want to use that data to underwrite you. They want to use it to personalize it, to cross-sell you a bunch of stuff. Like, they see data as a real competitive advantage, and leaking it out, or at least this was 5 or so years ago, leaking it out or allowing just open access to that kind of diminish their advantage. But what Plaid did, and the reason Plaid built such a valuable business, was because they unlocked that. They essentially built a new data rail that didn't exist. There were no APIs into banks. They managed to convince a bunch of banks to actually allow them access, which is no small task. And for those that they didn't necessarily build a direct API with, they did all the long work, the grunt work of building either reverse engineered APIs or screen scraping. There was a huge amount of effort into unlocking that data opportunity. But I suppose if you draw that parallel to payroll, there's some really interesting businesses popping up. So there's Argyle and there's Finch, and there's a number of others who've popped up who are describing themselves as the plaid for payroll. And actually, in some ways, there's lots of similarities because payroll, the value of the data in there is incredibly high, as you might imagine. It's validated income data, which is hugely important. And there's a number of similarities as well in the sense that there's quite a fragmented banking landscape, lots of big players, but a ton of smaller players as well. That's very similar in payroll. There's some big incumbents, there's a load of new challenges, but actually it's a really fragmented landscape. So actually there are some similarities between plaid and the plaid for payroll model. But actually, I see a lot more differences as well. It's when you start to then tease out those differences, you really understand that they're quite different businesses. And if you believe that a plaid for payroll is going to be equally as successful as a plaid, you really need to get into that detail. And a couple of examples are incentives. I touched on the fact that banks don't really want to let the data out. That's slightly different for payroll because the payroll providers, they're not really seeing that data as their asset. They're not seeing the employee as the captive data object, if you like, that they can monetize and they can cross-sell things to. So the incentives for them to hold on to it is less. But then equally, you've got different parties in the equation as well. It's not just a one-to-one relationship between the payroll provider and the employee. You've got the employer involved, you've got the employee, and you've got the payroll provider. So it's a bit more complex as well. And I suppose the most important bit is the utility of the data. Bank data, phenomenally granular, hugely powerful for a ton of different use cases. So everything, underwriting, affordability, loads of them, even proving your identity, all of that type of stuff. Payroll data, definitely valuable information, but a smaller subset of that information. So I suppose without really getting into too much detail, I suppose my big thing is that analogies really helpful to get that comprehension and that early understanding. But actually, our job as an investor and an entrepreneur's job and opportunity as well is to find those real differences, to really get under the skin of why these models are different, the importance of those differences. And only then can you really understand which model and ultimately which businesses are going to be the biggest successes.
Yeah, it's very interesting from a content creator's perspective as well. But now going to Mouro Capital, how does this complexity and nuance fit into your investment thesis and the areas that you're going to focus on?
Yeah, it's a really good question because one of the things that we're really working quite hard on, and since the creation of Mouro Capital, we've spent a lot of time on our thesis. We're increasingly becoming quite research heavy, spending a lot of time trying to formulate hypotheses and opinions up front and really getting deep down into each of the different spaces to really understand where the opportunity is. So I can share a bit more on a very high level thesis, but the other important thing is there's a degree of arrogance to some extent to believe that what the future will look like. We always have to adapt, and the entrepreneurs will create businesses you could never have dreamed of. Some of the biggest opportunities pop out of areas that you could never even have thought of. So I think you have to balance that thesis orientated hypothesis about what the future should look like versus just a complete open-mindedness to what entrepreneurs can bring. But I suppose having said that, on the thesis side, at 1,000 miles high, we have three broad categories that we invest in at Mouro. The first one being infrastructure. We see masses of opportunity across both the banking stack, but also the insurance stack as well. So think about every single layer of those technology stacks, everything from KYC, AML, core banking, collection, servicing, you name it. There's technology, innovation, opportunities across that whole stack. And many of the big incumbents have historically really struggled, obviously, with technology debt and the inability to innovate because of their technology stack. There's tons of interesting businesses, and we've backed a number of businesses in that vertical. So Truelaler is a good example, that are really just trying to do each individual layer of the banking stack in a much better, smarter way. And both incumbents will start to utilize this new technology, but also challengers who are building a new insurer or building a new bank will need to either build the technology themselves, but more importantly, probably start to use these new type of technology providers. So that's our first category. And I've categorized that as infrastructure. But I suppose, actually, before I move on to category two, one of the more important bits of that first category of infrastructure is it isn't just about being a technology provider that we're interested in. It's also this infrastructure as a service concept that I've talked about a bit in my blogs, and I think phrases like banking as a service are the ones that I think people will be very familiar with, but it cuts across many other different horizontals as well. So there's insurance as a service, there's brokerage as a service. We invested in Drivewealth, for instance, last year, who fit into that category. So that is taking not only the technology stack, but also the licensing component and enabling non-financial brands or other financial companies to start to offer kind of the end-to-end financial product using the infrastructure as a service. So that's category one, infrastructure. Second category, we really think about as challenges. Take any financial product, be it a mortgage, SME lending, you name it, auto lending, and reimagine it, rethink it. There's lots of different ways that you can obviously reimagine a financial product, but often it's a business model innovation that comes up or a data advantage that happens to come up. So completely new data sets that weren't available to the incumbents are starting to become utilized. It could be a new segment that the company's serving or a different market. We've invested quite heavily actually into that middle segment as well. And we've got, for instance, Uncapped in our portfolio. So we invested in them last year into their seed round. So Uncapped are a revenue-based financing company, which is really rethinking how you deliver financing to SMEs. They do it in a very different way. And similarly, we've got Klar and we've got Upgrade, who are challenger banks in Mexico and in the US. So very keen on backing new challenges where there's a new advantage. It isn't just a digitized version of the old, it has to be something new. And then I suppose our third category, quite cheesily, I call transcending fintech, but this is really more reimagining kind of what the future of finance could ultimately look like based on a number of big, huge societal shifts. So everything from blockchain to sustainability to mobility, lifelong learning. There's huge societal shifts that are occurring. And I often use the example of, will people buy a car, finance the car, insure the car? Probably not in the future. The service of mobility will fundamentally change. And therefore the role of money, the role of exchange of value, and the role of store of value is going to change as well. So we invest in business models that are really stretching away from fintech and more like adjacent categories and adjacent sectors where the role of money is changing.
What would be the example in your portfolio of that category?
So we've actually got quite a few bits in the blockchain space. Mouro Capital, although we're a brand new fund, we spun out from Santander Innoventures. So the fund has actually been around for about 5 years. So we've got a number of companies in the portfolio that are servicing, for instance, in the blockchain space. So we have Elliptic, we've got Navora, we've got a number of those as well. I think from a here and now, probably kind of the infrastructure and challenges, I would say, are probably kind of 80% of the investments that we do. And we're always looking for earlier stage investments in the third category.
So if we now zoom in a little bit more, and you mentioned Truelaler and the banking. So you've written this blog post, which we don't have to go through in details, but is banking on a headache. It's particularly interesting. Could you give us an overview of where Truelaler is compared to other sub-segments such as BaaS, so banking as a service platform, for example, and also maybe you can tell us a bit about why you chose that segment.
Mm-hmm. Sure. So again, I suppose touching on that complexity and nuance point from earlier, I wrote the Banking on a Headache blog primarily because I'd had so many different conversations where people were talking about open banking and they were referencing banking as a service companies. They were talking about banking as a service and they were referencing Truelaler. It's a really complex space. It's no criticism at all. And I really felt that actually that because there's so much terminology that was knocking around, some of it wasn't overly clear, some of it was, but it just needed a framework basically that was easier to get our head around. What I tried to do is basically segment it into basically that kind of combination of banking as a service, platform banking, and really split them apart. So the way I think about the world, and I mean, it's one man's view, is essentially at one end, you've got banking as a service providers. And what I mean by that is basically the delivery of a banking product as a service, often via APIs to other companies. So that could be companies like Railsbank or Modular, for instance, in the UK. There's a number of providers internationally as well. But the key there really is that you're providing the banking product itself, and that often requires the regulation as well. So we're very fortunate in Europe to have e-money licensing. You can offer a lot of what looks like a bank without technically being a bank. You can offer banking-like services on an e-money license. And a lot of these banking as a service providers utilize either a full banking license, and there are those who do that, or an e-money license along with the technology to enable others to offer a financial product. So that's what I call banking as a service, as a discrete category. There's then a second category, and I think, again, this is kind of nuance comes up a little bit, but in the US, you see a really different model because US is a completely different beast. Going and getting a banking charter in the US significantly harder than it is in the UK or in Europe, state by state regulation. And what we're not really seeing are that many kind of full end-to-end banking as a service providers. Instead, what we're seeing is this middleware layer. So there's bonds, there's Treasury Prime, there's a bunch of these companies that are cropping up and doing very well, who are essentially acting as a middleware connector between sponsor banks, so existing banks who are fully regulated, and often they're smaller community banks, and there's a lot of reasons why it's beneficial to partner from an interchange perspective with a smaller community bank, but a connector between essentially the balance sheet and the sponsor banks, and then the fintechs on the other side. So they're more of a connector layer, and a lot of the role that they're playing is as connector, but also as a compliance layer. They're translating the balance sheet to the new. So they are a very different business, I would say, to the bank as a service providers that we see in Europe in particular.
Interviewed the CEO of Synapse, and
Mm.
only after reading your article I truly understood where they fit. But when you imagine how it works, it's actually a very different dynamic. It creates a very different dynamic in the banking system if they own the full stack, so the banking itself, or not. So, for example, Synapse is a great opportunity for a small community bank because they can acquire clients for a very small cost via Synapse. So what seems very similar at first, the platform and the middleware, is actually creating a totally different dynamic.
Yeah, completely. And different opportunities from an investor perspective as well. And I think that's why the difference is really key, because the beauty of a provider in Europe who is deeply plumbed into the payment systems, who has their own licensing, is that they're in a lot more control of the full stack, a lot more control of costs, and there's a lot more opportunities to monetize of both front end but also back end revenue as well. Where if you're a middleware provider, as you say, there's tons of benefits to it, but you are in the middle by design to some extent. And the importance is not just being a middleware layer that gets squeezed and squeezed and squeezed and squeezed. Because if you're just another cost on top of another cost, you can see how over time compression will come into that space. It's that sort of thing that really makes a big difference. That if you're going to be investing in banking as a service, you've got to really think through the structure of it, the market, all of that type of stuff. It's hugely different. But I suppose those are the first two categories that I called out. There's a lot of others though. I mentioned sponsor banks. And what I mean by sponsor banks, as I say, is the community banks, the smaller banks, that's the balance sheet. Some of those sponsor banks, and this is where the lines get a bit blurry sometimes, some of them like to serve fintechs directly and have started to try and build actually out that connector layer themselves. But a lot of them are plugging into, as you say, the likes of Synapse and equivalents out in the US. Then I suppose you've got, and these are very different now, you've got pure play technology providers. So I mentioned when I was talking through our thesis at Mouro, providers who are essentially providing every single layer of that banking technology stack, and they don't necessarily have regulatory permissions. They're not bringing a balance sheet. They're not FCA regulated or internationally regulated. They're often just technology providers, but it doesn't make them any less important or any less interesting. They're just serving a very different customer. So rather than serving brands who want a balance sheet, they want the regulatory permissions, they want the full infrastructure as a service, they want that AWS of fintech, if you like. The technology providers are servicing the incumbents themselves, so big, huge banks who are trying to modernize and want a better KYC or AML solution, but also the challengers. And if you're building a new challenger bank today, would you want to build the full stack yourself, every single component of a bank? No, almost certainly not. What you often want to do is build probably some of it yourself, but more importantly, actually work with best of breed partners that can deliver infrastructure across the rest of the value chain. So that would be my fourth category, which is banking stack software or whatever you want to call it. And then you referenced Truelaler earlier. So open banking would be the fifth one. So open banking for me is a very different thing to banking as a service, and often they're bundled together. So open banking is about getting open access into banking services rather than providing banking services yourself. So if we're to use Truelaler as an example, Truelaler, incredibly interesting business because it enables, very similar to Plaid, it enables access to bank data. So it opens up access to the data that the banks have historically not wanted to let go. And it uses open banking rails, so probably one for another day, but PSD2 is enabled from a regulatory perspective, a lot more open access into bank data. But also they allow the initiation of payments over those existing banking rails as well. So rather than just being able to initiate, for instance, a faster payment within your own online banking system, it enables other companies to utilize that faster payment service through the open banking APIs. So they're really about opening up access to a system from the outside, whereas some of those other models that I talked about are about either rebuilding the core banking product itself underneath, or being a technology provider to it. And then I suppose the final one, the sixth one, it is six, questioning myself, is platform banks. And you hear this a little less now, but it was definitely a buzzy term 5 years ago. Monzo, Starling, and the like never really set out with a full ambition of providing every single banking product. They wanted to do one thing very well, which was checking accounts, current accounts in the UK. Wanted to do that extremely well, and then work with other providers to add in other financial products. And that was often termed a platform bank, because you're providing the platform and plugging in other products. Revolut is a really great example of that. They provide a lot of the services of what a full bank does, but a lot of those products are not actually provided by themselves.
Their expertise could be UX and other things like that, which are very hard to replicate. So this was a fantastic deep dive into the banking subsegment. So do we have similar issues with complexity in other broad areas of fintech?
I think investing is even more complex, to be perfectly honest. How long have you got? No, I won't obviously do a big deep run through like we did of banking, but we invested in Drivewealth last year, which is, they're doing incredibly well, and it's a fascinating business. So for people who don't know, Drivewealth is brokerage as a service, and essentially what that means is it enables other platforms such as Revolut. Revolut's a good example, who use Drivewealth. Enables other platforms to offer brokerage services, so stock and share trading, essentially. So you may be familiar with Robinhood. Robinhood is a very good example of a free stock trading app. It essentially enables Robinhood-like features to be embedded into other applications. And yeah, and coming back to them and infrastructure, I mean, as an investor, we're always thinking, is the right investment in the challenger? So should we be backing the Robinhood type business? Should we be backing the infrastructure? It all comes back to that thesis at the beginning. Or do you just want to back the technology that enables others to offer that type of service? And we saw a massive opportunity in the infrastructure as a service for brokerage, because challenger banks around the world are starting to embed stocks and shares trading, but in particular fractional stocks and shares trading, which is the speciality of Drivewealth, using it as a really core engagement mechanic in their app. So if you have a look at many of the successful ones around the world, they're getting a large amount of daily usage and daily active usage because of features like stock trading that exist. And so we increasingly saw that there was a big opportunity to be the provider for challenger banks, but also for many other different types of businesses who want to integrate that type of functionality. And brokerage is really hard. It's so complex. It's so difficult. It's so archaic in many different ways. And what Drivewealth's been around since 2012. They're not. They may sound like a new kid on the block, but actually it's the same. Overnight successes are made over 10 years. It's taken a huge amount of time to build out all that infrastructure, get all the licensing, do all the complexities that you need to ultimately offer brokerage, and then enable
Yes, indeed. Well. So again, this is where the infrastructure, like the people who take care of all that complexity, all that backend, and eventually come out with a slick interface and an easy interface, is really a fascinating one. It seems to me that, like you mentioned earlier, if you don't own the full stack, it could be a risk would be that those that own the license and things like that have a clear incentive into, okay, we want to build it, which is a challenge. But what are the challenges that you were considering in a business like Drivewealth? And maybe you can use Drivewealth as an example of what you think they're doing right in terms of commoditization, build versus buy, integrate, or
Yeah, you've touched on some of the really most important pieces actually when you're investing in infrastructure. The big question we ask whenever we think of any infrastructure as a service is, will this just be a temporary stepping stone before someone goes and builds it themselves? It's the obvious first question of, is this just easier, cheaper, faster to get going? And then once you realize that something's working, then you'll start to actually take and own more of it and reduce your costs over time. And that's the big question we always need to ask. And I think for some sectors, that's the risk. If you have a think of some of I often use the example of, nowadays it's incredibly easy to spin up a virtual card with block and block, a view pin and pan in, all of these things that were groundbreaking when Monzo and the equivalent were starting to roll out those features a number of years ago. Now it's incredibly easy because of the banking as a service providers. But actually, if all you're really providing is, I suppose, easy access to commodity features, you're always at risk of that you end up just with this incredibly long tail of clients that are just building kind of copycat products that are never really going to go anywhere. And that's always one concern, that you're just providing lower barrier to commodity products. And I think that's always a challenge, because ultimately for infrastructure, your success is very linked to the success of your end clients. You want to find the next Revolut. You want to power, the next big propositions, because often revenue is linked to transaction volume and usage and all that type of thing. So I think that's risk number one, that you're basically just enabling vanilla access to a lot more companies. And I see often a risk of a high degree of churn of those companies, because they'll either fail or realize that actually now it's become a commodity, they should probably do bits and pieces of it themselves. But I suppose more important is for those scale clients. So if you're a Revolut, or if you're in any of these big challenge banks or platforms that have really taken off, if you're just providing a commodity product, there is a point at which just the financial equation doesn't make sense. If you're paying someone else for that service and you can do it cheaper yourself, the question often will always come up of, well, should we not just build that ourselves? That makes sense. So I suppose, to bring it back to Drivewealth and model and those types of models, the thing we like about great infrastructure businesses are those that aren't just commodity vanilla, providing commodity vanilla products. If you are, you're at real danger of that customer mortality and that churn as well. So if you're the platform that can enable innovation, that you can do things that are incredibly difficult and others wouldn't be able to do easily on their own, you're more likely to be a long-term partner. And if you're always on the front foot, always innovating, always bringing out new features, always doing things that are just that bit further and further and further and further, that incentive for you to roll off and go and build it yourself gets further and further away by the day. So that was one of the things we loved about Drivewealth, because at scale, even with millions and millions of customers, would you really want to go and build everything that Drivewealth has built and prevent getting access to all the future great products and services that Drivewealth are building? Probably not. And at that point, it definitely isn't cheaper to build it yourself. So I think that's one of the key things, really, that not just providing a vanilla product, but being an enabler for innovation, not just lowering barriers for entry. And then I suppose the other piece, and I referenced it before when talking about the bank as a service middleware, is that if you're just the middle, you're very vulnerable to getting squeezed. And it comes back to a little bit of, when you get to scale, it obviously becomes a lot more expensive. You're going to be staring at that supplier that's costing you quite a lot of money, and you're probably going to start putting a lot of contractual pressure down and really trying to chop the pricing that they're charging. So I think if you're providing any sort of middleware, you can't just be a cost plus model, because that plus is going to get smaller and smaller over time. You need to be able to monetize across the full stack. And again, I mentioned Treasury Prime. They're a nice example in the US, who have a twin-sided business model. They charge both the banks to create APIs for them, and then they also charge the fintechs for getting access to those APIs. It's a really nice model. And those types of businesses that can monetize across the stack are the ones that I think are the most interesting, at least.
Yeah, that's really interesting. And that's also where you really can understand the skill of a VC. So we've talked a lot about how do you differentiate yourself as a fintech startup. Now, how do you differentiate yourself as a VC?
Concept of marketing within VC it's very different to a normal business. Ultimately, we're in the business of selling money. I know that might sound a little bit cynical, but really, if you try and draw analogies, you don't sell widgets, we sell money. And I suppose the difference is, for us, if you're selling a consumer product, there's tons of opportunity to differentiate, and you can imagine whatever product. Where in VC, I suppose that ability to differentiate is narrower. There are fewer things that you can completely differentiate yourself from the pack than perhaps in other businesses. I want to debate, but so I think VCs are always trying to find ways in which they can separate themselves out, where they can look different, sound different, behave different. We actually spend a bunch of time internally really thinking through, we don't want to be passive money. There's plenty of money out there. We want to be able to really add, without sounding cheesy, but add a lot of extra into the company to be able to help them move to the next level, to be really supportive, and to do all the things that they would hope for someone who would sit around the table could do. We spend a lot of time, we talk to our portfolio, we do interviews, all that type of stuff. And often it comes back to people, going back to that kind of spectrum of how far you can really differentiate. Often what really a lot of entrepreneurs are after is supportive, knowledgeable about the sector, not just happy in the good times, but can be there in the bad times, can bring in other contacts or network or whatever it may be, but it often just comes down to the individuals that exist within the fund. And I think a key thing for us really is that we want to obviously double down on fintech. We want to be fintech specialists, and we want, I suppose, entrepreneurs want us around their table, to be an investor, to be in their cap table, because we can bring knowledge, we can bring experience, we can bring contacts, we can bring network, very specific to the fintech domain. So how does marketing fit into that? I think then it's about telling the story of the individuals. Do you want me as an investor in your business? Do you want other individuals within our fund as investors in your business and long-term partners? Because it is a marriage. And so I do think content has an important role in that regard, because it's a way, it's not just saying, hey, we're Mouro, we invest in fintech. We're actually saying, look, this is what we believe in. We've got a differentiated perspective. Sometimes we're going to be wrong on a bunch of that stuff, but we have an opinion. This is what we believe. And it really just helps, I suppose, really communicate what us as individuals believe in and stand for and are looking for. And hopefully it's just a way of demonstrating who we are. And I think that's probably the best marketing that you can do as a VC fund, is really opening up and sharing who the individuals are, rather than selling in a more traditional marketing sense.
Yeah, that makes perfect sense. And it also helps to understand a move that has been talked a lot about from Andreessen Horowitz, who are doing, I think, an amazing job at marketing themselves, and eventually are doing so much content that they create their own, they launch it as a separate business, and then they also have managed to use their own investments, such as Clubhouse, to hype it even more.
Yeah, there is. The other challenge with content is there is a lot of it out there. But one of the things that I'm very conscious of doing is I'm not someone who is tweeting every other day. I'm not someone who is just writing something for the sakes of writing something to improve. That's not our objective. It's not my objective either. What really I'm trying to do is, as I say, communicate what I believe in, and I think content therefore has to be often slightly longer form. It has to be a lot more considered. And it's time consuming. Writing a blog piece is really time consuming. So I would much rather write 5 or 6 really, hopefully well received pieces that stimulate a debate and at least communicate what we think, rather than just content for the sake of it. So there is a balance between the two.
I think you did a fantastic job there, because your articles are really a point of reference for me every time I try to think of a segment of fintech. So thank you very much for dedicating the time to that. And as a final question, do you have typical advice that you share with the founders that you meet, with the founders that you invest in the fintech space?
So I came from VC having been an entrepreneur. So I founded a company called Parity back in 2014, which we sold to Tandem Bank, and I spent a couple of years at Tandem as well. So I try and wear 2 hats. So I always try and wear the entrepreneur hat and the investor hat. So I suppose I'm not sure whether it's VC advice per se, but Parity was an amazing, challenging, difficult, brilliant experience over 4 years. But it was hard. And I think my one advice to entrepreneurs would be, there is nothing glamorous about being in a startup. It's often glamorized. It is hard. It is difficult. You need so much grit. You need so much determination. So much is going to go wrong. So given that context, you really need to just make sure that the business that you're building is something you're incredibly passionate about, and something that you're continually validating and finding that there is really an opportunity space there. I think some of the worst things you can do is work on a problem that is a vitamin, a problem that isn't really going to fundamentally change or unlock anything for either society or for businesses, whatever it may be. And often you see entrepreneurs not quite finding product market fit, but then that business just running for many years after and it not quite going anywhere, because it's such a big life commitment, because starting a business can be such an amazing thing. That would be always my advice, which is solve a problem you passionately care about, throw as much grit and determination and perseverance at it as you can, but also just always be questioning, like, are we actually building the right thing here? Is there a really big enough problem in this space? And we're not just running a startup because running a startup is more fun than working for a big company. We're solving a genuine problem that exists, and we're doing something that is actually could be solving that problem.
Wonderful advice, Matt. Thank you so much for your time and your insights. And we'll put the links in the description below so that people can know what we've been referring to, and also be able to find you on the internet. Thank you.
Cool. Thank